Hi, and welcome to this course on algorithmic trading. In this course, we will explore algorithmic trading basics and we will learn how to build and backtest our own trading systems and strategies in Python. I will also guide you through building and backtesting your profitable trading strategy that is provided and explained in details in this course. As an example, you can download the source code and use it for your experiments as a starting point. The results we obtained in the example strategy are showing 12% in returns, even when we applied 5% commissions on each open trade, which is a relatively large percentage of commissions. But this shows that we have a good starting point that we obtained without any optimization, just following a simple set of rules that usually help you define a profitable system. So in this course, you will learn about these rules and how you can leverage these to build your own profitable strategy that you can backtest and use it for manual trading, or you can also automate it in Python. So the purpose is not to copy the strategy provided as an example, but rather to learn the correct way to automate and backtest any trading strategy using Python. My name is Ziad. I have been coding trading algorithms for more than 10 years. I have used MetaTrader MQL5 language before moving to Python, where I could implement machine learning and neural networks into my trading. Today, I'm happy to share my experience with you and guide you through this course. More discussions on this exciting topic in the coming lessons. But first, let's check the prerequisites and the course content we will be walking through in the coming sections. This course is built straight to the point to save your time. So the content is focused on trading and algorithmic trading. We're using Python language, but this is not a Python course. We will not go through the basics of Python and we will not explain variables, functions, and classes. But we will keep our focus on numerical trading systems. So in the coming lessons, we assume that you already have some Python background. You don't have to be a senior developer either, but just to know some basic concepts that we will be using to code and test our strategies. So you will need to be familiar with how to run a Python code, at least in a Jupyter notebook. You need to know what are variables, functions, classes, condition statements, loops, and so on. You will also need some object-oriented knowledge, such as classes and objects, nothing very advanced, just to be able to import modules, inherit some classes, and use instances in a program. And you will also need some knowledge using pandas and NumPy to manipulate data sets. Obviously, at some point, you would want to slice your data, change the selected period to test your strategies. So all of this can be done using pandas. If you think you are lacking any of these areas, I have other courses detailing these parts separately with some practice exercises. So if you are just starting your coding journey, you can find my Python Basics course and follow up with the Object-Oriented Programming course. And I also have a special course focusing on NumPy and pandas and data manipulation. So you might want to check these courses first, see what fits your profile best, then come back for this one. But if you already feel comfortable with Python, we can jump straight into the fun part. This concise overview encapsulates the essence of the course's content. Its intention is to offer you a lucid understanding of the topics we will be covering and the specific aspects of algorithmic trading that will be explored. So we will start with a small theory part where we're going to introduce algorithmic trading. We're going to talk about human emotions in trading, developing a trading mindset, pros and cons of algorithmic trading. These topics will be discussed first because I believe this is the basis of choosing to trade using algorithmic trading. Then we're going to move on with the trading concepts, trading terminology that we're going to use in the course, technical versus fundamental trading, and basic trading strategies. We will also list the types of algorithmic trading strategies, mean reversion, momentum trading, and statistical arbitrage, going through the details and explaining what are the differences for these three types of trading from the algorithmic point of view, from the numerical point of view. Then we will talk about data retrieval, how you can get your data and apply your EDA, your exploratory data analysis in Python, using timeframes, text data, data sources, and how you can visualize your candles very quickly in Python. Then we will talk about technical indicators analysis, the libraries in Python, Pandas technical analysis, and so on. So how we can implement technical indicators with Python libraries, how we can use them for our trading strategies. Then we need to test these technical indicators using some basic statistics. So we'll go through this as well. And then on the seventh part of this list, we're going to jump into strategy development and optimization. So what are the main components of a strategy, strategy choice, implementing and testing your strategies in Python. And I believe this is one of the main components or the main chapters of this course. Then we need to work more on backtesting, so how to evaluate the performance of trading strategies, choosing your entry signals and your correct exit signals as well, and how you can manage your trades once they are opened, the lot sizing, and many more topics that would improve your profitability. At the end, we're going to see briefly how we can execute live from Python. I'm just showing one example using Wanda, but you can apply this example to any broker providing a Python API. So I know that most of the known brokers, they do provide today the Python APIs and libraries with some documentation that you can be using to execute your trades live from within Python. Hi, and welcome again to this course. In this lesson, we will be discussing the basic ideas behind algorithmic trading and how it has changed the way we trade in financial markets. There's a lot of new trading and investment companies nowadays that are using algorithms to improve their decisions on the market. So we will cover a lot of topics such as developing a trading mindset, managing stress and anxiety, advantages, and also the disadvantages of using algorithmic trading. In reality, trading is not easy and can be a stressful activity. So traders need to manage their stress and anxiety levels to make rational decisions. Algorithmic trading can help reduce stress and anxiety levels by automating a part of the trading process or trading decisions and eliminating these emotional biases that happen usually during the waiting process. So if you're waiting for a certain setup on the market and it's been a long time we haven't seen this setup, the trading becomes tedious. It becomes very hard to wait and we get bored, we get frustrated. Slowly, so we don't notice this happening. And this is sometimes one of the reasons we make those trades out of the system that we are trying to follow. So for example, a trader may feel anxious about missing out on a potential profit opportunity, leading to, impulsive trading decisions. An algorithmic trading system, on the other hand, will follow a predetermined set of rules and execute trades based on data analysis only, without the interference of emotions. Now let's talk about developing a trading mindset. A trading mindset is essential for successful trading, and it involves developing discipline, patience, and emotional control. So traders need to have a clear understanding of their trading goals, risk tolerance, and trading strategy to develop a successful trading mindset. For example, a trader may have a goal of earning a specific profit target over a specific period, and to achieve this goal, they need to have well-defined trading strategy, which includes risk management, entry and exit criteria, and money management. If the goal is not very realistic or not achievable, this is not going to work. So we need to have realistic goals and realistic specific profit target. Now, before we continue, it's important to highlight that algorithmic trading is not to be confused with automated trading. While both employ the use of software and technology to aid in the trading process, algorithmic trading works as a support tool for the trader, while the automated trading involves the use of a bot to execute trades autonomously. In algorithmic trading, the trader remains in control of the decision-making process using algorithms as a means to streamline and optimize their trading strategies. Algorithms are used in trading to identify trading opportunities, execute trades, and manage risk. They can be used to automate trading decisions. For example, an algorithmic trading system can scan the market for specific patterns, such as moving averages or support and resistance levels, and execute trades based on these patterns, so predefined patterns. Additionally, algorithms can be used to manage risk by setting stop-loss orders, trailing stops, which limits the potential loss on a trade, for example. So one very simple example of algorithmic trading is the trailing stop that changes with the price movement. It's not a fully automated system, but it's still a form of using algorithms to our benefit in trading. So if you have this question, does algorithmic trading work? Well, actually, think about the trailing stop. This is one form of algorithmic trading. Human emotions play a significant role in trading decisions, and traders often make decisions based on their emotions rather than logic and analysis, especially if we are in the beginning phase. So this is the best way to lose in trading. You probably heard about revenge trading, which is a reaction of traders who have recently suffered a loss in the market and seek to recover their losses very quickly by taking impulsive trades that may not be based on sound trading principles. This is where traders go out of the system and they go rogue somehow, and this is the best recipe to wipe trading account. So this behavior is driven by the trader's emotions such as anger, frustration, or fear, rather than rational thinking. As usual, your trading anxiety increases with the amount of money you are risking. If you are risking too little money, or you are opening a paper account, for example, not real money, you find that your results are much better than when you are risking a big amount of money. Even on the same account, if you are trading on small position size, you find yourself trading well, so you're profitable. But then when you start increasing your trading size, the lot size, emotions come into play and it might affect your results. This is where algorithmic trading becomes helpful. It eliminates the emotional biases and improves the quality of your trading decisions. And you can also use algorithmic trading to backtest a strategy that you think is profitable. You just want to make sure before trading manually, you want to backtest the strategy just to make sure that it's really profitable in different circumstances and in different times. So this is where algorithmic trading is really good. In contrast to human behavior, an algorithmic trading system will follow predetermined rules all the time, stick to these rules, and execute trades based on data analysis and logic, which reduces the impact of emotions on trading decisions. So what is algorithmic trading? It's a type of trading where decisions are made by computer programs using predefined rules. These rules are based on statistical analysis, technical analysis, and other mathematical models to identify trading opportunities. Obviously, you would have tested these rules before applying them to real trading situations. And algorithmic trading can be used in different financial markets such as equities, derivatives, forex, currencies, and commodities, and so on. So there is no restrictions from this point. I always get the question if a strategy works on such and such market. Well, after some tuning, the answer is obviously yes. Any strategy can be optimized for different markets. Some examples of basic algorithmic trading strategies are trend following, mean reversion, and statistical arbitrage. We will go through more details about these topics later on in this course. Now let's talk a bit about the role of emotions in trading. So before we do this, let me tell you a story what happened to me around 10 years ago. I was constantly wiping my trading account within 3 to 4 months, and in the middle of the frustration, I was discussing with a colleague trader who was in the same situation as I was. So he was also wiping his account. Somehow we were eager to just make it in the trading hobby at that time, not for the money because we had good life in general, but more out of curiosity and to try to beat the market somehow. And we decided on a genius small experiment. Whenever I go long, he would go short on the same asset. And whenever I go short, he would go long exactly on the same asset. This way, if I lose, he wins. And if I win, he loses. Or if he loses, I would win. So it's very simple. So at the end of the day, at least one of us would have a winning position. Without any surprise, we both wiped out our accounts still. The reason is that no matter how good your trend guess is, and no matter how good your technical analysis is, you still have to manage your trades, your risk-reward ratio, and mostly your emotions to know where and when to exit a part or the total of your trade size. So think about it this way. The trade starts, or the trading starts actually after the trade is opened. What happens before opening the trade is the simple part. It's a simple technical analysis. You can check your indicators, your technical indicators. You can check the trend and so on, and your entry point. And you enter the trade, you open the trade, long or short. But then what happens after the trade is opened will be affecting the trading outcome, I would say around 70% of the times. Now, algorithmic trading has several advantages, including the ability to process a large amount of data very quickly, the elimination of emotional biases, and the ability to execute trades automatically. So if you are trying to follow a large amount of or a large number of assets, for example, you're going through Forex, equities, stock market, and so on, and you don't want to keep following and attending behind those different screens, checking all the assets at the same time. This can be tiring if you're doing this half a day or a full day. Algorithmic trading can help in this perspective because you don't have to wait. The algorithm will be looking for the patterns on your behalf. However, there are also disadvantages to algorithmic trading, such as the potential for technical errors. So the need for continuous monitoring. We need to monitor the algorithm from time to time to check if things are still working as expected. And another risk is the risk of over-optimizing trading strategies. This happens when you are trying to backtest a strategy, fine-tune some parameters, and you fine-tune usually the parameters to get the most or the best result ever. But then when you run this strategy on the market in real time, we notice that the results are not as we expected. And this is because we over-optimized the strategy on the past or the historical data, which doesn't mean necessarily that it's going to perform as well on the future data. If you come from the machine learning background, we call this also overfitting. Also keep in mind that if you are using algorithmic trading in a fully automated system, so automated trading, don't forget that you are risking your money or putting your money in the hands of a software. So any technical error in an algorithmic trading system can lead to significant losses if not monitored by a human and addressed promptly. So additionally, over-optimizing a trading strategy can lead to poor performance in real market conditions. I think these are the two most important disadvantages to keep in mind when we are using algorithmic trading and automated trading. Strategies can be broadly categorized into three different categories. So we have the trend following strategies, the mean reversion, and statistical arbitrage or grid systems. Trend following strategies involve identifying the direction of the market, the trend, and taking positions in the same directions. So these strategies work well in trending markets and can generate significant profits, but needless to say, they don't work well in ranging markets. Then we have the mean reversion strategies. They involve identifying deviations from the mean or the average price of an asset and taking positions to profit from the price correction, assuming that the price will be going back or converging towards the mean curve. So these strategies, they work well in range-bound markets where prices tend to revert to their mean values. Then we have statistical arbitrage strategies. They involve identifying mispricings in related assets and or correlated assets and taking positions to profit from the price differences. So these strategies, they require sophisticated mathematical models and algorithms to identify mispricings accurately. I would advise you to start with one of the previous two categories. So the trend following, I like a lot the trend following strategies, and even the mean reversion strategies, they also work well in algorithmic trading. Now let's talk about Python, or the Python language. It's a programming language. It's very popular, that is used in algorithmic trading because of its simplicity, flexibility, and rich set of libraries and tools. You can do basically anything using Python. Back-end, front-end, machine learning, neural networks, trading, calling APIs, connecting to your broker's website, passing trades, opening trades, closing trades, you name it. So Python here is a prerequisite, and as we already mentioned, you have to be familiar with the basics of Python for this course, including data types, variables, operators, and control structures. In this course, we will see how Python can be used to develop trading strategies by implementing mathematical models, technical indicators, and risk management algorithms. And we will also see how to access and analyze financial data from various sources, such as APIs, databases, and web scraping. So get your Python environment ready, and see you on the next lesson. Now we'll be discussing some trading concepts that we will need before we try and build our trading systems. So these concepts will be needed to understand what's happening under the hood, why the market is moving, and how we can approach the market in putting together our own custom strategy. Okay, now let's try to talk about some of the trading concepts. The first one I'm going to talk about is the technical versus fundamental trading. Trading approaches can be broadly divided as technical and fundamental. Here's a breakdown of these two methodologies. First one, technical analysis. This approach relies on historical price patterns, trends, and indicators to forecast future price movements. So traders using technical analysis believe that historical data can help predict the future trends. It's purely numerical. We don't take into consideration any news or any other sources of information other than the numerical charts that we are seeing in front of us. While the fundamental analysis, fundamental traders focus on analyzing economic indicators, company financials, and other relevant data to assess the intrinsic value of an asset. So they believe that the market prices will eventually align with the company's true value. And for this, you have to have access to the company's data or the company's real financial performance. So, which also makes sense somehow. A fundamental analysis also makes sense, just like the technical analysis does. However, to follow fundamental trading approach, you need to have access to the correct data that would allow you to evaluate a company or an asset. From this perspective, I think that technical analysis might be easier. But we can always incorporate both approaches into one strategy. For example, using technical indicators along with text and sentiment analysis from news data sources. And this way we can have our technical analysis and we can have our confirmation from fundamental analysis. At the heart of the market or market data lies the bid and ask spread. And this is a topic that's always discussed even on my YouTube channel, like how do we take into account the spread between bid and ask prices? This is a fundamental concept that underpins pricing dynamics. The bid price represents the maximum price a buyer is willing to pay for an asset, while the ask price signifies the lowest price a seller is willing to accept. The difference between these two lines is the bid-ask spread, an indicator. It can act actually as an indicator of market liquidity and the ease of executing trades. So understanding the bid and ask spread equips traders with the ability to gauge supply and demand. And this is why it's important to understand what's happening under the hood, these trading concepts, before you build your own system. Because if you look at the bid and ask price as just a spread or some kind of a fee that you're going to pay when you buy, you go long, and then you sell, you go short, that's not enough. A bid and ask spread is also an indicator. Notice when you are trading, when the market reaches the end of the day, the spread is going to be wider because the liquidity is decreasing, because simply traders are closing their trades and they're not trading anymore. While in the morning or in the middle of a session or a popular session like the US session, the New York session, you notice that on the most popular assets, the spread is very thin. Notice the US dollar euro, for example, it's a very wide spread in the evening, and then it's a very thin spread during the day. So if you're building a custom trading strategy, the simplest you can do is simply allow your system and test your system during those periods where the spread is very thin, meaning the liquidity is very high. Then we have trading volumes. Trading volumes provide a window into the intensity of market activity, so helping traders also gauge the enthusiasm or caution of market participants. So price movements displayed in candlestick charts capture the history of price changes over specific time periods. This is what we call the time frames, enabling traders to discern patterns and trends. So these patterns, combined with technical indicators, guide trading strategies and decisions. So again, the narrow versus wide spread. A narrow spread indicates high liquidity, as the difference between the bid and ask prices is relatively small. This suggests that there is a significant number of buyers and sellers actively participating in the market, leading to a tighter pricing. And this is good. This is one indicator that this is a good moment for trading, actually. While a wide spread suggests lower liquidity, as the bid and ask prices are farther apart. This can be indicative of a market with fewer participants or a less active trading environment. And not only you can increase your losses if you are trading during a widespread period, but also you are probably trading when we shouldn't. Because if no one is trading during this time, it means that everyone knows this is a bad time for trading. This is how you can look at it this way. So to avoid trading during bad periods when the market is probably volatile or the market is probably closing very soon and before holidays, before weekends, or before the next session is opening. One tip to consider is try trading volume alongside the spread. High trading volume coupled with a narrow spread indicates robust market liquidity. On the other hand, if you see a low volume paired with a wide spread, it may signal a reduced market activity and potentially higher trading costs. So this is probably one way to use these two indicators, either to enter the market or to avoid the market. No matter which strategy you are building or no matter which strategy you are using, this is the first gate actually that you have to be considering before entering the market. If you want to know the liquidity trends, which means like how the liquidity is changing, is it increasing, is it decreasing, and so on, you can observe the spread. You can observe the spread, but not now. You can observe the changes in the spread. So if the spread is widening, it means the liquidity is decreasing. If the spread is decreasing or getting thinner, it means that the liquidity is increasing, meaning more people are entering trades, more people are putting more money into the market right now. So I'm not talking about the absolute value of the spread, this we already mentioned now. I'm talking about the trend of how it's changing through time. Is it getting thinner or is it going wider? And we can extrapolate this to know or to forecast what's going to happen in the next couple of hours. Another type of data is the asset type. So different asset classes have varying levels of liquidity. For example, major currency pairs in the Forex market tend to have a narrower spreads due to their high trading volume and liquidity. In contrast, less commonly traded assets might have a wider spread. Try to check, for example, the Euro US dollar. It's always with a thin spread, but if we check the Euro versus the Polish zloty, for example, it's going to show a wider spread. Another gate to cross or another condition to verify before we enter any trade using our algorithms, or before letting our algorithm enter any trade automatically, is the news and the events. So you have to have an eye on the calendar, or your bot has to have an eye on the calendar of the day, of the week, and so on. So significant news releases or events can impact liquidity. And during times of high volatility, spreads may widen as market participants adjust their positions. So you don't want to trade during these times, because anyway, if you're building an algorithm, it's a systematic strategy that doesn't behave well when you have weird values or weird noise going on the market, such as volatility and news releases. Algorithms work well when the market is going systematically. It's very slow, you don't have high volatility, and things are going as expected. So the trend is continuing. If it's an uptrend, it's continuing going up with as little noise as possible. If it's going down, it's going down smoothly with as little noise as possible, using those retracement forms going up and down, and overall a moving average that is dropping down. These conditions are perturbated or become very noisy and unavailable when you have those news and events. And we've all been through these hard times of news releases, and I think you know what I'm talking about. It's also good, before you build your strategy, before you build your trading system and putting it into an algorithm, to understand what types of financial markets we have. So financial markets are the lifeblood of economic activity. So it facilitates the exchange of assets and capital across the globe. Let's explore the main types. So the first one is equity markets. Equity markets, like stocks or shares, represent ownership in a company. So investors, they buy and sell these shares in the stock market, and equity markets provide companies with access to capital for growth and expansion. So it's the companies who are selling some of their shares, and you have other investors that are buying these shares to invest in the companies. Traders and investors can engage in long-term investments or capitalize on short-term price movements through active trading. Then comes Forex markets. So the foreign exchange market, or Forex, is the world's largest and most liquid market. This is why it's very volatile. It's moving every day very quickly. And if you know it well, you can make a lot of money. If you don't, you can waste your money very quickly. So here, currencies are bought and sold in pairs, reflecting the relative value of one currency against another. Forex trading offers opportunities for speculation and risk management, catering to a diverse range of participants, including individual traders, institutional investors, corporations, and central banks. And to be honest, Forex market is one of my favorite. I feel safe when I'm trading Euro US dollar or US dollar gold and things like this. So the majors mainly, because it moves very quickly and it allows me to close my trades within 2 or 3 hours. I don't have to wait 2 or 3 days and sleep over trades, leave my trades opened overnight, not knowing what's going to happen the next day. Then comes commodity markets. So they revolve around the trading of raw materials such as metals, energy sources, agriculture products, and more. These markets play a critical role in global trade and supply chains, and they are classified into 2 categories: hard commodities like gold, oil, and metals, and soft commodities like wheat, coffee, and cotton. I've never traded wheat, nor coffee, nor cotton, to be honest. Traders can speculate on price movements or use commodities to hedge against risks. Then we have derivatives markets. They offer instruments whose value is derived from an underlying asset. This category includes options, futures, swaps, and more. Derivatives provide opportunities for hedging, risk management, and speculation. Options, for instance, allow traders to buy the right, but not the obligation, just the right to purchase or sell an asset at a predetermined price in the future. Then we have the bond markets. Bond markets deal with debt securities issued by governments, municipalities, and corporations. Bonds represent loans made by investors to these entities. who promise to pay back the principal amount along with the interest. Bond markets offer relatively stable investments and serve as a benchmark for interest rates and economic conditions. And we have real estate markets and cryptocurrency markets. So I'm not going to go into the details of each of these, just to show you how diverse these markets are. And it's not only the Forex market we've been seeing and I've been trading on my YouTube channel. It's not only the cryptocurrency markets. It's not only the stocks and so on. You have a lot of other markets that you can enter. I personally don't like to take the risks into markets that I don't really know and I'm not familiar with. This is an increased risk actually. So if I'm buying cotton and I have no idea why did I buy cotton, just relying on technical analysis, I don't think this is a good recipe for a good profitable trading. Now, about the cryptocurrency markets, we have seen that there's a lot of algorithmic trading going around cryptocurrency, and this is only because these cryptocurrencies, they involve a lot of volatility. They offer a high volatility. The market is very volatile, and the potential for substantial gains attracted traders and investors seeking exposure to innovative financial technologies. To be honest, it's a bit like traders got bored with the classic trading, stocks, Forex, and so on. Then came cryptocurrency and it looked more appealing, something new coming to town, and they started trading. Unfortunately, recently, the cryptocurrency market went down in general. So it's not the hype anymore, but it's still a market where you can trade and make some profits. So navigating these financial markets requires a deep understanding of their unique characteristics, risk profiles, and trading strategies. So I don't assume that one strategy that works in the Forex market has to work also on the cryptocurrency market or should work on the stock markets, for example. It might. One strategy might be working on 2 or 3 markets, but it depends a lot on the market and on the strategy and how compatible these two are. So I'll not go through all of these in details because that's not the purpose of this course, but it's just important to get familiar with the market you intend to trade. It makes things easier when you're building your strategy. Now let's talk about market participants. This is very important for algorithmic trading. To be honest, when I look at candles and the charts and the candles patterns, like the bullish engulfing pattern or the shooting star or the doji candle, all I can think of is who's doing the sales in the background. So, and these are the market participants. This is the list that we can see here on this slide. The financial markets form a complex ecosystem with a wide array of participants, each contributing to the movements of supply and demand. And this is what we can see on the charts. So the first, let's say, market participants are retail traders. So they are individuals like you who engage in trading for personal investment, make up the retail trader segment. They often trade through online platforms, brokers, and applications, seeking opportunities for profit across probably various asset classes. And they can range from beginners in trading up to the most experienced individuals implementing sophisticated strategies. Then we have institutional investors. These are large entities that manage substantial amounts of capital on behalf of others. Institutional investors, they include mutual funds, pension funds, hedge funds, and asset management companies. Their investment decisions impact the market due to the size of their trades and their ability to influence asset prices. So in other words, these are investors, they have so much money that when they buy, they can move the market. You can see it on the market. You can see a green candle if they are buying. You can see a red candle if they are selling with a full amount. So then we have the market makers. They play another important role in maintaining liquidity by continuously providing buy and sell codes for a specific asset. They profit from the bid-ask spread, contributing to efficient price discovery and ensuring that trades can be executed promptly like when you are buying, basically, if no one is willing to sell, you need to buy from someone. These are the guys that would allow you to buy. If you are selling and no one wants to buy an asset, these are the guys that would accept to buy from you in any condition. So these are the market makers. They include brokerage firms and financial institutions. Then we have hedge funds. They are pooled investment funds managed by professional portfolio managers. They employ a wide range of strategies from long-short equity to quantitative trading, algorithmic trading, automated trading, computational trading, you name it. They have all the possibilities to invest into the best possible algorithm. Then obviously we have banks and financial institutions. They engage in trading for their own accounts as well as on behalf of the clients. They can provide essential services such as facilitating transactions, offering credits, investment, and managing risk. Investment banks, in particular, engage in trading activities that can impact market movements. So they have so much money that when they buy, the market goes up. When they sell, the market goes down. And we also have central banks. So we're not going to go into the details. They are simply the monetary authorities of a country. So you can guess that they also have a lot of money. And when they are trading, the market is moving. Then we have corporations, companies with publicly traded stocks. These are also market participants. They can issue shares to raise capital and may engage in share buybacks to enhance shareholder value. And we have algorithmic traders like you and I, or maybe like larger algorithmic trading companies. I've met one company. I've had the opportunity to discuss with them and to check a bit of their algorithms and see how much money one can expect to make from algorithmic trading. But anyway, for this slide, I'm just going to tell you that these are also market participants. And the best thing you can do now is understand the motivations and actions of these participants, because this is an essential step for interpreting the market trends and making informed decisions. So we need to understand what's happening from the charts. It looks like most of these market players are buying, they are going long, so let's go long because obviously they will trigger an uptrend. Or if we notice they are going short from the charts, let's follow along, ride the wave with them, and expect that they are going to trigger a downtrend. Now let's talk about some types of algorithmic strategies. So these are not the types of trading, it's just the types of algorithmic trading. First one is a mean reversion trading strategy, so profiting from price swings. Mean reversion strategies operate under the premise that an asset or asset prices tend to revert to their historical averages over time. These strategies identify instances where an asset price has deviated significantly from its average, anticipating a subsequent correction. So we wait for the correction, we expect the price to go back to their average, and this is where we try to make our position. Traders using mean reversion strategies aim to capitalize on these price swings by taking positions that align with the anticipated reversion. So by implementing mean reversion techniques, you will learn to identify overbought and oversold conditions, allowing you to enter and exit trades at good moments. The second one is momentum trading strategies, riding the wave of trends. And this is one of my favorites because it's algorithmically the easiest to implement. So what happens for this type of trading? Momentum trading strategies, they operate on the belief that assets in motion tend to stay in motion. These strategies identify assets with strong price trends and aim to capitalize on their continued momentum. So we expect a trend to continue and we trade in the direction of the trend. Traders employing momentum strategies, usually, they seek to ride the wave of existing trends, entering positions that align with the market direction, with the current market direction. So if we understand the momentum indicators and how to follow the trend or trend following techniques, we can identify trends early and capture potential gains. The third one is a statistical arbitrage, exploiting price disparities. This one is a bit tricky, in my opinion. I did try it at some time, and it was very profitable, like extremely profitable. It felt too good to be true. But then again, it doesn't work in all market conditions, because in other times, it wasn't a very profitable strategy. So it wasn't a negative. However, the positive side, like when the market is ranging, it covers for the losses you can make when you have long-term trends. And you should also be careful when you have high momentum in the market. You have to turn your strategy off, or probably put a condition to automate this strategy or your bot to be turned off during very fast trends. But in general, these statistical arbitrage strategies, they rely on quantitative analysis to identify price disparities between correlated assets. So you take 2 or 3 assets, and they usually are correlated. If you can find 3 correlated assets, for example, you can check how they are moving in general. But then when you see a disparity or an anomaly in these movements, or in the ratios between the price of one asset to another correlated asset, you know that this is not going to last long, and you make the trade in the direction of the correction of the correlation. One example of trading these arbitrage strategies is when traders take long and short positions at the same time in correlated assets, aiming to profit from the convergence of their prices or the future convergence of their prices. Because we know they are correlated, and when they spread a lot, or their prices they spread a lot, we expect these to converge back in the future. So these strategies, they require you to know the history of the assets and how the correlation works before you try to enter these this type of strategies. And this brings me to the fourth point on this slide, which is the algorithmic trading strategy implementation and bridging theory and practice. So is it even possible? In the next section, we will start bridging theory and practice by guiding you through the implementation of algorithmic trading strategies. So far we have seen a bit of theory. It was essential to understand what's happening on the market or under the hood somehow. And now you will start learning how to translate your strategy concepts into code, automate trade execution, and perform backtesting to validate your strategy's effectiveness. So we will move on into a more technical side of this course. And I hope you enjoyed a bit the theory. It brought you a bit of value. And now we're going to learn how to build a strategy and how to implement it in Python. In this section, we will be talking about data retrieval, visualization, and exploratory data analysis. So the first thing I want to mention is the type of financial data. First point is the time frames and candles. So these are the candlesticks or the candlestick data. They are among the most commonly used data types in algorithmic trading. So time frames refer to the intervals at which data points are recorded, such as minutes. You can have 1 minute time frame, hours, days, weeks, and month, and so on. Candlestick charts, they visualize this data by representing each interval of time as a candle with an open, close, high, and low price. And that's what we're going to download or retrieve as historical data when we want to build our strategy and backtest it. This format offers a kind of a compressed view of price movements over time, aiding in identifying patterns and trends. It eliminates noise, because if you look at the tick data point by point, it's like a cloud of points. You wouldn't understand, or we wouldn't see the trend very clearly or any kind of patterns. While if we condense everything into rectangles, which are the candlesticks, in this case, we are easily eliminating the noise or part of the noise that comes with the trading data. So the pros of using time frames and candles includes their ability to provide an overview of price action and trends, making them useful for long-term strategies. And they also save a lot of space. Technically, if you want to download, for example, tick data, we noticed that the size of the files is huge compared to candlestick data. So let's take an example of a candle of 1 hour, if we are working on the 1 hour time frame. So this candle is represented by 4 values: open, close, high, and low. And it represents everything that has happened during 1 hour of trading. While if you want to plot or get the data of the details, it's going definitely to be much more than simply 4 different values. This is why they make the data concise, they reduce the noise, and they save space, and it making also the algorithmic trading tasks much easier technically. However, there's a con, or there's a drawback to using candles. It's that we might miss out on finer intraday movements due to the aggregated nature of the data. So whatever happened during the hour or during the day is simply summarized into one rectangle and might not be seen on the candle chart. So ticks data, also known as tick by tick data, records every individual trade executed in the market. This is a very granular data that captures price changes at the most fundamental level, offering the best precision for short-term and high-frequency trading strategies. So you can't be more precise in getting data. Ticks data provides deep insights into the market dynamics, order flow, and potential liquidity issues. However, due to the huge amount or the huge volume of such data, ticks data can be resource intensive. So you will need high computational power and space to store the data and then to process and analyze whatever you want to extract from the data. So this required advanced techniques to manage the data efficiently. The benefits of using ticks data lie in its accuracy and the ability to capture rapid market movements, which enables traders sometimes to exploit fleeting opportunities. But on the level of personal algorithmic traders like me, probably you watching this course, I don't think we need ticks data unless if you have something special in mind. I always used the hours and the 4 hours and the daily time frames, and it was more than enough in my case. But if you go down to the minutes time frames, it's already too noisy for the algorithms we are building. Some different types of algorithms can deal with such noise. I usually prefer to avoid lower time frames. Another way to represent data that we can practice as an exercise, for example, it's kind of a think out of the box idea, something a bit original or exotic, I would say, is to replace candles by custom violins or violin plots instead of candles to visualize additional price movements or price information. So why violin plots? Because they show the price distribution within a time frame, so we would know where the price exactly spent most of its time. For example, on this violin plot, we can see that this is the thickness has the maximum thickness is at this level. So we know that the price, even though is showing a high at this point or a closing price at this point, it's showing that the highest probability where the price was is on the lower side of the candle. So I think this is something interesting to be investigated. It's an idea that I'm proposing here. I never investigated this, but I think it holds a great potential to show more information. So this one here, for example, is showing a very high thickness at this level, which means that we have a lot of points, a lot of tick data that happened on this level. So if you're looking at a daily time frame, and this is one bar or one candlestick that's representing one day, it means that the violin plot is adding this information, showing you where the price was trading during most of the day. So you're not omitting those details anymore. You're not skipping those details that are not included in the normal candles chart. There are some considerations to take into account. So first of all, we have to understand how violent plot works. So in order to be able to interpret the violent plots, it might not be as intuitive for some traders because we are basically used to using candles. So when we see these violent plots, it might look a bit weird. And I didn't try it, so I don't know how it would look like in real life, how the time frame or the chart would look like in real life. And then it requires tick data. So you can't build violent plots from candlestick data. You need the tick data to build the candlesticks and the violence as well. One more consideration before moving on to the coding part are the data sources. So algorithmic traders have access to a multitude of data sources, including financial data vendors, APIs of brokers where you can download the data, exchanges, and alternative data providers. Each source comes with its own strengths and limitations. So established financial data vendors, for example, they offer structured and reliable data, making them suitable for backtesting and historical analysis. So this is good in our case. Exchanges provide real-time and high-quality data directly from the market. So this is good for forward testing. If you want to test live your bot or your trading strategy, you can do it using this kind of data, but the cost can be higher. And we have also alternative data sources, such as social media sentiment or satellite imagery. They can provide unique insights, but might be less standardized and more challenging to integrate. So the choice of data source often depends on the specific trading strategy, data accuracy requirements, and budget considerations. I'll give you an example on how, for example, satellite imagery can help you in trading. If you're trading some assets like gas, for example, and we all know that during very cold seasons, sometimes shortage of gas is happening, and therefore the price of gas is going up. Or in the opposite, if during the cold season we don't have a lot of cold and there's a surplus of gas, the price of gas will start dropping down. Using telemetry data to probe or forecast the weather and using satellite imagery can inform you like 1 week ahead or 10 days ahead on what are the possibilities that might happen in the future coming days. And if you are already on a downtrend, let's say the winter in the US wasn't very cold, so we have a lot of gas, the price is dropping down, it's a downtrend in the price. You can follow the weather conditions provided by cloud providers or cloud services to see if this trend is going to continue down. Because the moment you see a storm coming or a forecast of a drop in temperatures, you might want to exit your trades before things revert back into an uptrend, or before simply the downtrend will be stopping and the market starts ranging. But these are sophisticated cases. I've seen people doing such studies, and it's very interesting to do, and it's very fun to work on this as a full-time job. To be honest, I've had some colleagues and some friends doing this, and it's really a nice topic. But if you are building this at home, you don't need to go into such sophisticated and complex strategies. There are much easier ways that would be as profitable, but maybe you are taking a bit more risk in this case because you are just checking the numbers instead of also checking the fundamental analysis of temperatures, weathers, news, and other data sources. I will show you two free and simple methods that you can use to download financial data for your trading and strategy backtesting. In the first method, we will use Python code. The second method is using the Cascopy platform with a free account where you can have free access to a large set of data that includes Forex, majors, minors, metals, stocks, futures, and even more. Much more than we usually need for a backtesting. So let's start with the first method, which is the easiest, straight from Python. Make sure to install the YFinance library library before running this code by using the pip install yfinance. So the way I'm doing this, you can open a terminal in your code or in VS Code and you can pip install it. If you don't have a terminal, you can also do this from within your Jupyter notebook. Just open a code cell, you can type the exclamation mark, then pip install yfinance. So I'm not going to run the cell. I think if I run it, it should show me that I already have installed the package. Yes, so it's already satisfied. And in your case, it's going to install this. Then you can import yfinance just like any other library or any other package. Then we start by specifying the ticker symbol, the stock you are interested in. In this example, I used the AAPL. I think it's the Apple stocks as an example. Then we create a ticker object. So this is done using the yfinance.ticker function that takes as an argument the ticker symbol. So it depends on which stock you want to download the data for. Then we can use the history function to download the historical data for that ticker symbol. We specify the interval and some other parameters, as you can see. So we have the start date, the end date, and then the interval that we can see here. So in this line, I'm downloading between the start and end date using the interval 1 day, which means it's a daily time frame. So to show you what this does, I'm going to comment this second line that we're not going to use now. I'm going to run this. We can wait for the data to be downloaded, and then we can print the data frame that's supposed to be containing the data for the Apple between these two dates. So it's 1990 up to 2022. That's a lot of data. Let's print this and we can see that we have 8,315 rows. Now this means that we've just downloaded the Apple stock prices between the start and end date, and we have 8,315 days of data because each row on the daily time frame corresponds to 1 day. And there's another way of doing this. As you may have noticed, the second line, I'm going to comment the first line in this case. So instead of just specifying a start and end date, I'm just going to put a period. I'm using the period parameter, and the period here is equal to 20 days. So what this does, it's going to download the, let's say, the hourly time frame for the last 20 days. This is good if you want to stream live. So if I want to download, for example, the last 20 days, using the daily time frame, I'm going to run this again, the content of the historical data, and we can see that we should have 20 days. So I don't have the length here because it printed all the rows. So I'm going to print the length of historical data, and it should be equal to 20. And this is exactly what we have because we've just downloaded for the period of 20 days, meaning the last 20 days, and the interval is equal to 1 day. So the daily time frame, we've just downloaded the last 20 days of data. And this is all going into the data frame historical data that we can see here. There are some limitations that you should be aware of. So the available time frames are 1 minute, 2 minutes, 5, 15, 30, 90 minutes, 1 hour, 1 day, 5 day, and so on. So up to 3 months. However, the 1 minute data, so if you want to download data using the 1 minute time frame, it's only retrievable for the last 7 days. You can't access anything except the last 7 days. And anything intraday, so less than 1 day, the hourly time frame, 4 hours, and so on, this is only available for the last 60 days. So if we try to download, for example, the 1 minute time frame, so 1M for the last, let's say, 8 days, we usually should have an error, and this is what we can see here. So 1 minute data is not available for start time with an index and end time with another index. So the rest of the message showing only 7 days worth of 1 minute granularity data are allowed to be fetched per request. Now, if we start again using 7 days, it should work fine. So that's what we have. And the length is around 2,664. Remember that the yfinance package will be cleaning the weekends and the days off. So we only get candles or data where the market has movement. Now, if we try the 15 minutes time frame or a longer period, let's say 70 days, and we execute this, and we can see that 15 minutes data is not available. And let's see the limits. The requested range must be within the last 60 days. So if we decrease this to the last 60 days, I think it's going to work, and it worked. So we can print the length of the data frame now. So it's 1547. So this is for the 15 minutes time frame. And I think the more you increase the time frame, the more data you have access to. So for example, if we go back to 1 hour time frame and we print for the 60 days, definitely we have access to this. Let's try and increase this to 120 days, and it's still good. Maybe 320 days, it's still okay. I think it's somewhere around 700, the limit. Or maybe we can just increase it to more than 1,000 days and let yFinance tell us the limit. So it's 730 days for the 1 hour time frame. One more limitation of yFinance that we should be aware of, it's not an official Yahoo product. So, which means it relies on web scraping and may not always provide accurate or up-to-date data. And this is developed by a third party. Regarding the maintenance, also we have no idea at some point if it's going to carry on or not. Another point to be aware of is that you are probably limited with the number of queries that you can use this for, since this is relying on web scraping approach. So you might get your IP banned if you are querying repetitively. This means that it shouldn't cause you any problems if you are just building strategies like this, trying to backtest and so on. I mean, if you query 10, 20 or 100 times, that's not a problem. Problem is if you build a bot and you're trying to query every minute many times continuously over 24 hours or so. So this is probably going to be flagged by the system at some point. Anyway, for the moment it's working. A lot of traders are using this and it works great for now. We can enjoy it. Now I'll move on to the next method, which is also as easy and it's free as well, using the Dukascopy platform. So Dukascopy is a Swiss banking group that offers this platform for trading. This video is not sponsored by them. It just happens I'm using their service and it's for free to get the data. So you can scroll down their page and at some point there should be, you should find this historical data feed. So I'm going to click on this. It's going to open this interface right here where you can select which data you are interested in. So we have the Forex, we have the crosses, the majors, metals, and so on. You have commodities, indices, bonds, stocks, anything you wish for. I never needed anything that's not in this list. For example, we're going for Euro US dollar. So I'm going to select Forex, majors, Euro US dollar. We're going to tick this one. And then we can choose either the tick data or let's say the time frame. I'm choosing hour. I'm downloading, for example, now the 4 hours time frame. You can choose, is it the bid or the ask price that you want, and the dates, the starting date and the end date. We also have the option to filter flats, meaning weekends and days off. So I'm disabling this. I just like to keep all the data and then filter everything in Python. Day start time, I usually use UTC, time to GMT in order to have a universal time. And the precision could be millions or thousands. Then you simply press download. And this is where you have to create an account. It's for free. There's no money to create this account. You can opt for the free option. It's just that you need to have a login and password. And once this is done, you just click on the download, you sign in and you click on the download and you can get your file in a CSV format. The file is being downloaded. I just logged in. So sometimes it gets stuck at 50% for a while downloading the file. And then don't forget to click the save as.csv file. So when we click this, you will get the file in your browser or in your downloaded files. This is it. Basically, these are two free and very easy methods where you can get historical data. I usually also use a third method with my broker. So you can stream live data from your broker if you want to query data more frequently so you don't get banned using yFinance or any other methods. But for backtesting, for the sake of backtesting, if you just want to have a CSV file or download a data frame to test an idea of an indicator or a strategy on, I think these two methods should be more than enough. In this example, we are loading a CSV file. I'm importing pandas as PD, and then I'm using the read_CSV function providing the name of the file that I've just downloaded from Dukascopy, for example. And this is a daily time frame, Bitcoin versus US dollar candlesticks, the ask price between 2017 and 2021. Then I'm loading all of it into a data frame, a variable called df. I'm printing the df just to make sure that the data was loaded properly and checking also the content of my data frame. This is a very important step to be familiar with the data that we have. So we have the time column, we have the open, high, low, and closing prices of each row, so of each day, or in other words, each candle, because we're working on the daily time frame. And we have the volume. And this is very important because this is an indicator on the liquidity, as we have discussed before, but also it's going to show me where or which days we had trades and in which days we didn't have any trades. So if the volume is equal to 0, it means this was a day off, was a weekend or a holiday, or for some reason the market wasn't opened. And we can use this column to filter those days from our data frame. So I usually do it when I'm downloading the data from Dukascopy. We have an option to skip these days, and I usually tick it when I'm downloading, so I have cleaner data. I don't have to download data that I'm not going to use. And also I do it again in Python using this line. So I'm overwriting my data frame with the part of the data frame where the volume is different than 0. So I'm only keeping the days where we had trades. So now that we have our data frame filtered, we can compare before and after the filtering. And we can see that we don't have a big difference here. I had 1,306 rows or candles or days. And then after the filtering, I have still like 1,304 or 1,305 rows. So in other words, I didn't have a big difference between these two just because I already did some filtering while downloading from Dukascopy. So I usually don't like to download the whole pack of data without the filtering because it would mean that I'm downloading data that I'm not going to use, so this is useless. I can simply tick the box from Dukascopy, and just to make sure things are as clean as possible, I also do my small cleaning here in Python. Then we can plot a slice of our data frame. And when I say a slice, I mean I'm taking the first 50 candles, for example. We can take a different slice, but the reason I'm plotting a slice is just to make it clear on the graph. So if I don't make any slicing, for example, if I plot the whole data frame, we can see that we can't distinguish any candles. It's just the whole history of the price that's changing. It's good to know, it's good to see, but if you want to do some analysis, some detailed or precise analysis, you might want to go deeper and zoom in into these candles to see how they are changing with the price. Okay, so I'm using Plotly to graph. So after slicing, I have the data frame for plotting, dfpl, which is a small slice of my data frame. And then I'm importing Plotly graph objects as geo. And I'm using the function called figure, which has a feature candlestick. So this is another function that I'm using here to select the data. And I'm using the data, I'm using the index from my data frame, which is the time. This is the x-axis. I'm not using the time, actually. This is the integer index axis. We can use the time, but we need to reformat it in a way that would fit on the x-axis, because this way it's way too long as a label to be reported here on the figure. So it's easier to plot with the integer index in this case. So we have this integer index, which is our x-axis. This is why we have x is equal dfpl.index. And then we have 4 features: open, high, low, close parameters. And these are equal to dfpl open, so the column open, the column high of the data frame, the low and the column close. So I'm providing these to the function, just as this function requires these parameters: open, high, low, and close. When we provide these, the function is going to plot the candles, because this is a feature from Plotly that's going to be very helpful in the future. For more visualization options, we're going to go through these in the next video. But for now, this I think is enough to plot quickly some of the candles. If you want to select a different slice, of course, you can select, let's say, from index 50 or 500 up to 1500. And this is also a good way. So I think we've done a lot here. Let's try to shrink this. Let's say 500 to 600 should be enough, and this is better. So it's working. We can plot this, we can check the data, the content of the data. So that's one way of doing this. There's also a different way that we have already mentioned, is using the YFinance download function. So in this case, I'm using a very concise version of it. I'm downloading, let's say, the tickers, Bitcoin, US dollar, period, the maximum allowed period, and interval is 1 day. And interval is 1 day. Then I'm plotting the tail just to make sure that we are plotting this. So I'm going to try to run this now. And then I can see that it just downloaded whatever data, the most recent data actually, and for the maximum period of time. So we can plot the tail, we can plot the head, just to check the start and the end date. Then I can reset the index, and I'm using in place true because we need to override the current index, and we keep the date as a column just in case we want to use it later on. Again, we're selecting another slice of the data frame, and we're plotting this. Let me try to plot it again. And this is what we're having. So we've just loaded the data in two different ways, and we've plotted the data using Plotly Geo. So this is good so far. Now, if you want to add some indicators, you can do so using the Pandas technical analysis module. So I'm importing pandas_ta as TA, and you might want to install this using pip install. Let me show you how to do this. I'm going to my terminal. I'm opening a terminal, and you can do pip install pandas_ta, and if we run this, it's usually going to download and install your Pandas technical analysis package. So we don't need it because at mine it's already installed, just so you know. And this is a very useful module, a very useful package. It allows you to compute technical indicators immediately and directly using these simple functions. So you don't have to hard code these or to code these from scratch again, because these are already pre-coded for you. So I'm creating a new column in my data frame, so df EMA for exponential moving average, and I'm using from TA, the pandas_ta package, I'm using the function called EMA. So exponential moving average, it requires the closing price for this and the length which is equal to 10. So I'm taking basically the last 10 candles over the time or over the data frame. It's a sliding window of data frames. And if you're using VS Code, you can hover your mouse over the EMA or the name of the function, and you can see how many parameters it requires and what are the types. So we need the closing. This is the first parameter, and then we need the length, and then you have other parameters that I'm not using. I will not talk about these now. The simplest is to use it as I've just shown you in this example. Then I'm also computing the RSI with the length 10. I'm adding this as a column into the data frame using the function RSI, providing the closing price again, and the length is equal to 10. I can run this and print the data frame just to check what's the content of it now. And we see that we have the time, open, high, low, close price, and the volume. We had these before. And we also have the EMA column now and the RSI_10. Now for the plotting part, we can easily take a slice just as we have done before from the data frame. So I'm using the first 50 candles or 50 days from the data frame. And again, I'm providing for the candlesticks the open, high, low closing price. But this time we're going to add from go.scatter function. We're going to add again the index as an x-axis, but on the y-axis, I'm adding the EMA and I'm providing a style of drawing it. So line is equal to a dictionary, where in the dictionary we're providing the color, which is equal to red, and the width is equal to 2. And then I'm providing a name in case I want to include this into a good legend. So if we plot this, I'm going to run it. We can see that we have now the exponential moving average appearing also as a red curve on top of our candles. So the reason we don't have the line on the first between the index 0 up to 9 is because our EMA has a length of 10. So we took length 10 here. So we need at least 10 candles in the data frame to compute the first EMA value. And this is why we don't have any values at the beginning of our data frame. Now, if we plot, let's say between 50 and 150, we should have these, and we don't have any gaps in the EMA data. And that's a quick introduction on how to include the data, first of all, and some technical indicators, and how to plot these and add them on the graphs. Now, if you want to know all the technical indicators that are provided in the technical analysis package, we can call df.ta.indicators function just like this, and you can see we have a list of the tools that are provided. So we have aberration, above value, and so on. So we have the ATR should be somehow here, average true range, Bollinger Bands, and a wealth of the CCI, a wealth of other indicators that you can use. So all of these are functions that would provide you the technical indicators or classical technical indicators that we usually need in our analysis. So I'm not going to go through all of them. As you can see, this is the EMA. So once you have identified actually one of these functions, you can call the help function. So help ta.rsi, for example, and you get somehow a documentation on this function. So you can check what kind of arguments, what kind of parameters it requires, and you have a brief description. As you can see, you have a link. Where are the sources coming from? So this one is coming from TradingView. So you have your documentation regarding the RSI on TradingView, and then you have the calculations here with default inputs, as you can see, and some description and details how the math is being computed within the function, and then the return value. So I find this very helpful whenever I know which technical indicator I need, but then I don't know how the function was built. I can check the help immediately, and I know how to use the function for to get my technical indicator into my data frame. And you may have noticed that we also have some candle patterns that were coded here. So we have 3 black crows, 3 inside, 3 outside, and so on. Let me see if we have an engulfing candle. So we have a doji star. So we have an engulfing candle here, and stars, evening star, and so on. So the hammer, hanging man, as you can see. So these are nice. I mean, they are here, but I personally prefer to code these myself because I don't know what was in the functions and how these are coded. So we could, of course, go through the functions and check how these are coded, but the way we do it ourselves will give us more control, obviously, because we can modify how we are computing these and adapt these to the strategy or to the specific cases where we are using these price action patterns or candle patterns, and so on. So if you want to use these, you are free, of course. These are very helpful. If you are going for a quick trial and a quick experiment, you don't want to spend too much time on this, you can use these, but I myself prefer to do these candle patterns in my code as specific functions. So this is it actually for technical indicators. This is the quickest, fastest, and simplest way you can plot your technical indicators, get the values, and keep them in your data frame for later analysis.
Visualizing financial data is an important step when you are building your algorithmic trading model, because it's always easier to see the action on a graph instead of reading plain numbers. In the previous video, we saw how to download financial trading data from online resources in the form of CSV files, or even directly into our data frame from the Python code that we are writing using Jupyter Notebook. This video is dedicated for data visualization, so we're going to see how to plot price movements, candlesticks, moving averages, and how to add scatter points, lines, and maybe other indicators on the chart. So this is our Jupyter Notebook page. I will start by downloading the data using yfinance package, just like we have explained in the previous video. So I'm importing yfinance as yf, and my data frame will be equal to yf.download. I'm using the download function, the Bitcoin versus the US dollar prices, the maximum period that is available on the servers of yfinance, and we are downloading the daily time frame charts. Now we can print what was downloaded and loaded in the data frame. And I can see we have the open, high, low, close price, the adjusted closing price, and the volume for each date. At this point, we can use matplotlib to make a normal plot, just a graph using the closing prices, for example. So my data frame is called data. First of all, I'm importing matplotlib.pyplot as PLT. Then I'm using the plot function. I'm providing for the coordinates the data.index, meaning the index of my data frame, and then the data.close, and we can show the plot. So this is the data that we have starting from 2014 up to 2022, and we can see the closing prices of the Bitcoin throughout the years. Or we can choose simply a small slice of our data frame. For example, I'm going for data frame plot, for example, is equal to the slice of data, let's say the row 0 up to the row 100. And then I'm replacing here the FPL. Now I have like a zoom in graph between row 0 and row index 100. And these are the first 100 days, let's say, of our data. And if you care about aesthetics, you can change the color and the style of the graph. For example, I'm putting comma green O, meaning green point. And we're going to try to run this. It should be between double quotes. This is how we get our graph. It's the same plot, but now we are using green dots instead of the lines. Of course, you can change this. For example, we can put blue dots, and now we got our points in blue, and so on. So as you can see, you can have a lot of parameters that you might be able to modify just to change the look of your graph. To give you just an idea, you might check the plot function online. There's a wealth of parameters that you might be able to change. And for example, if we are interested in plotting the highs, we can simply replace this close by high. And now we will get something slightly different because we are plotting the highest points of each candles. Okay, but these are not candlesticks. And if you would like to have more professional or more financial data looking graph, we might use the plotly.graph_objects. I'm importing this as GO, and then I'm declaring a new variable called fig for figure, which is equal to the figure outcome of this function. So this function is going to take different data formats, and in this case we are interested in using the candlesticks parameter. I'm putting data is equal go.candlestick because I'm transforming my data into the candlestick format. So the function would understand it as a candlestick. First of all, the index is used for the x-axis, and the rest are the 4 parameters that would define a candlestick. So we have the open is equal to DFPL open. So in this case, we have to slice again our DFPL. I called it the data frame for plotting. This is why I called DFPL. So I'm putting this here, and again we are plotting the first 100 candlesticks or the first 100 days of our data. So the x-axis is DFPL.index, then the opening price is DFPL open column. The high price is DFPL high column. Notice they are all separated by commas right here. The syntax here is very important because all of this is going into the data parameter. So the opening price, the high price, the low price of the candle, and the closing price of the candle. And at this point, we can simply close the parentheses. Then we add the figure.show function to show the figure. So we have this slider to zoom in, and we can move it left and right and so on. And if we want to remove the range slider from our figure, we can add an update where the layout x-axis range slider visible variable is set equal to false. So now when we run this, we get our figure, but without the range slider. If you are into aesthetics and you would like to change the colors of your candles, we can add some parameters within the candlestick function that we can see right here. So we have the X index of the data frame, then we have open, high, low, close price, and then we can have the colors right here. We can add these here. So I'm going to add these into a new line so we can see them clearly on the screen. And then we have the increasing line color is going to be set to yellow. In this case, I chose yellow for increasing candles, and the decreasing candles are going to be colored in blue. And this is our candles pattern now. So as you can see, we have the colors of the upgoing candle and the downgoing candle. If you want to change the color of the background and the page where we are plotting our figure, we can update the layout, and the paper background color is going to be black for the sake of this example. I'm going to run this, and this is the paper background color that we can see here. If you want to change the background as well, we can change the plot color this time. So we have the paper background color and the plot background color, which is also set to black in this example. So we can put blue here just for the sake of the example. It's not going to be a good choice because the blue candles disappeared with the blue of our plot. So anyway, you see the point. I'm going to put it back to black, having something looking like this. And notice that we have a certain margin around our plot. This also can be modified in the layout of the figure. I'm going to do this on a new line here, but always in the update of the layout. We have the margin L, meaning the margin left. I'm going to set this to 0, margin B, meaning bottom, the right, and the top. So I put these to 0, and notice now if I run this cell, the picture is going to be wider on the whole canvas where we are plotting. So it's filling the page somehow because our margins are set to 0. If I add my margin left, for example, to 100, I'm going to have a margin on the left of my plot. For the moment, I'm going to put these to 0, and we will have the biggest figure that we can have to fill our screen. And if we would like to modify the grid and the x-axis and so on that we can see here in white, we can add these lines, figure.update underscore x-axis and y-axis, and inside we have a few parameters that we can modify. So showing the line of the axis is equal to true because I would like to plot the axis. The line width is equal to 2. The line color is black. Well, if the background is black, it's not very smart to do this. So I'm going to put white right here. And the grid color is going to be black because I don't want it to show on my figure. So I'm going to put white for the y-axis as well. We're going to run this, and this is what we get. So we can see the white x-axis and the y-axis. The grid disappeared in the background because it's of the same color of the background. And now we have our candlesticks on a black background. Now we can start adding indicators or lines and scatter points on top of our candlestick charts. So if, for example, I would like to add a support resistance line right here that I can see it, I'm going to add this manually on top of this chart. After the candlestick parenthesis is closed right here, I'm going to add a comma, and on a new line, just to be visible, I'm going to add a scatter point. So scatter points where the index is the x-axis, but the y, since we don't have the exponential moving average in our data frame, I'm simply adding the line. So I would add a line around, let's say 45K. It's going to be a line that is equal to color red, let's say, and the width is equal to 2, and I'm gonna name it support/resistance. Okay, there are two corrections we have to make here. First of all, this one should be into a list, so the data is going to be a list. First of all, it's going to be the candlesticks up to here, and then comma, it's going to be the scatter points or the lines. So we're going to add closing the list of our data. And the second correction we have to make is that our y is indeed equal to 45,000 everywhere, but it should be in a form of a list of an array. So it's going to be the same value, which is 45,000 times the length of our slice of our data frame, the one that we are plotting. And we see that we have added our red support and resistance level line just at 45K. If we want to add another line, we can insert this into the list just before closing the brackets. So I'm going to add a comma and then we put a copy paste of the same line, go.scatter. The x-axis is always the index of the data frame, and here, for example, if we would like to add something around 51k, I'm going to put 51 of the same color. I'm going to add it with the same name and run this, and at this point we have both lines added into our graph. And we can add points for signals, for example. I also added within the same list, I put a comma here, and using the same function, go.scatter, the x is the index of the data frame, and the y this time, I'm adding points just on top of the highest points or the highs of the candlesticks. So y is equal to dfpl.high plus 100, let's say. And the mode is equal to markers, because I would like to have markers. The marker is equal to dictionary, size equal 5, and the color I chose medium purple. The name is equal to signal. I'm going to run this. We can see the purple points that were added just at the highs of our candles. So of course, these are meaningless for trading for the moment, but if you want to add scatter points or lines or even curves, you can do this using this function. If, for example, I change the size to 10 at this point, we're going to plot this, and we can see that we have increased the size of our markers. And if I want to position these below the lows of the candles, here I'm going to modify it and putting dfpl.low minus 100. So I'm going to place the points just below the lowest point of each candle. We can see that the scatter points are now below the lowest points of each of our candles. The other parameters and functionalities that can be used using Plotly for financial data can be found on their webpage. For example, we can add vertical line and add some notations on our charts. If you have any presentation to make, this would be useful. The easiest way to access the list of colors that is available in Plotly, actually we can put something that is wrong in the color, for example, section here for this variable, and then the Plotly is going to provide us the list of the available colors. Try it instead of the blue right here. And now it's working, and we can see that we have gray candles and so on. If instead of the purple, I would like to choose something else, again, we can put something wrong here. We get the list. So the medium purple is going to be replaced by this one, medium orchid. Just to try something new, I'm going to run this, and we have different colors, and so on. The Plotly website contains more information about the different types of visualization that you can have access to. Of course, the Plotly website and the web pages, they are providing more information about the types of visualization options that we have access to.
Okay, now let's talk about technical indicators and how we can test the relevance of a technical indicator for a trading strategy. In fact, if you intend to use a technical indicator, you can test the goodness and the efficiency of a specific formula or an indicator just by using simple statistics in Python. You don't have to backtest a full strategy, or you don't have to write a long backtesting complex code. You can just rely on simple statistics and simple counts, and I will show you how in this section. So this is useful and handy because it's an easy way to test the components of your strategy each on its own. So you can build it with small building blocks. In this section, we're going to focus on the technical indicators because these are a big part of our trading strategy, our trading systems. So if you have a simple idea, like for example, you'd like to test if an RSI is a good indicator somehow of the future of the trend, or is an engulfing candle a good forecasting tool, this type of classic indicators can be easily tested and quickly tested to see if it holds any value for a specific market in Python. In the following videos, we will be detailing some of these indicators, and I will be providing you some examples on how you can test the relevance of each indicator for your strategy. So technical indicators, they come in different types and shapes, and you have also custom indicators for specific types of markets. So for this course, we're going to detail 4 types of indicators. The first one is the trend indicator. Then we'll talk about momentum indicators, also the volatility indicators, and then we'll see some volume indicators. This part, we will talk about trend indicators. These tools, they help traders identify the direction and the strength of the market trends. And I really like to use these tools because I usually, my preferred way of trading is to trade with the trend, following the saying, trend is your friend. So I use a lot of these indicators in my day-to-day trading. So these indicators, they help in understanding the market trends. Before we explore trend indicators, let's clarify what market trends are and why they are crucial to traders. A market trend is essentially a general direction in which the price of a financial asset is going to move or is moving over a period of time. So this direction can be either upward, which is a bullish trend, or downward, which is a bearish trend. So this is how we call these the bull and the bear. Identifying these trends is a crucial and very important step if you are building an algorithms for trading. So it's crucial also for manual traders because they provide valuable insights into the potential future movement of asset prices, which can guide your future trading decisions. Now, I do understand that all the indicators lag, and I do agree with this, but in trading, we are counting on the fact that the trend is going to continue at least for a few days or for a few hours since the moment we detected it. So this is what we are betting on. Like if the trend is up, we are betting on the fact that in the next couple of hours, we will be still in an uptrend, so we can make some profit out of this. And this is how it works. Even though the indicators are lagging, classic indicators are lagging, and they tell you nothing about the future for real, but we can still use them in a smart way to our benefit. In algorithmic trading, the first challenge you will face if you are building a trading strategy is how do I detect the trend as soon as possible and before it's too late, because sometimes you detect the trend and it's at the end of the trend, so it's no use anymore. So we'll talk about this more in details in the coming sections. In this chapter, however, for now we are sticking with the technical indicators that are related to trend detection. The first example I'm going to talk about is a very widely used example, which is the simple moving averages. So these are fundamental trend indicators. They are still being used up to today to smooth out the price data and identify trends over a specified period. So SMAs, or simple moving averages, they provide a very reliable way to identify trends and filter out noise in price data. As an example, we can calculate, for example, and interpret SMAs using a 50-day SMA to illustrate their applications. I'm going to show you this in a program, and we're going to see how we can use this in Python, adding the SMA into our trading system and using the candles to detect an uptrend or a downtrend. So you can also download the Python file. I'm going to share it with you. So you can download the IPython notebook that I'm going to use in the video. So you can follow along and maybe experiment on it, changing the length of the SMA and checking how it modifies your data. Then the second example is the exponential moving average, which is a replacement somehow of the SMA or a different version of the SMA. Exponential moving averages usually place greater emphasis on recent price data. So it gives more importance on the recent candles rather than on the older candles, making them more responsive to trend changes. So if a trend is changing, the EMA is going to show this change faster than a simple SMA. So we'll calculate and interpret EMAs as well, with a focus on a 20-day EMA, also in the programming or the coding example I'll be providing. The third example is the average directional index, or the ADX. So it helps traders determine the strength of a trend. We'll detail the calculation of the ADX later on, show how it can help identifying the strength of trends. So first we need to compute the DMI, or the directional movement index, the first step in calculating the ADX. So for this we have to compute two components, the positive directional index, or the plus DI, and the negative directional index, which is the minus DI. And these are calculated based on the difference between the current high of the current candle minus the previous high of the previous candle. And same thing for the negative DI, which is the difference between the current low and the previous low. So we usually make the previous low and the current low for the negative DI. Then these values of the positive DI and the negative DI are smoothed over a specific period. Typically, it's 14 candles period, and using an exponential moving average that we already explained. So we apply the exponential moving average on the plus DI and the minus DI, and we obtain the smoothed values, the DI plus and the DI minus. Then we apply this formula where the ADX is equal to 100 times DI plus divided by DX divided by DI plus plus the DI minus. So again, the DI plus and DI minus are the smoothed plus DI and minus DI values. DX is the directional movement calculated as the formula, so DI plus minus DI minus divided by DI plus plus DI minus. So the ADX is then smoothed over a specific period, typically 14 periods, 14 candles, using an EMA. So as you can see, we don't want to give ourselves a headache using a lot of formulas for this course, or providing a math course. This is not the purpose. It's just sometimes it's good to know some of the basic formulas to know how these indicators work, why do they work in some situations, and why in some situations they don't work. So just to avoid some surprises and to add to our understanding. So the ADX values range from 0 to 100 usually, and we can consider that from 0 up to 20, this indicates a weak or non-existent trend. Traders might avoid trading in such conditions. And if it's between 20 and 40, this suggests a developing trend. So you might want to wait a bit to check if it's going to be confirmed later on. So it may still be considered a weak trend so far. So traders may be very cautious and look for confirmation from other indicators. However, if you can see an indicator or an ADX between 40 and 60, this indicates a relatively strong trend. Traders would consider entering or holding positions if you have already an open positions in the direction of the trend. And whenever the ADX is between 60 and 100, this suggests an extremely strong trend. So you might see this as an opportunity to ride the trend, but also you should be very careful in this case, because usually trends that are very fast like this, when the ADX is between 60 and 100. So if you see an ADX around 80 or 85, this means you have a high volatility market. And it doesn't necessarily mean that you have a strong trend or an extremely strong trend. Sometimes it can show a lot of noise as well. So the optimal values, I would say, are between 40 and 60 for the ADX as a confirmation of the current ongoing trend that you can also confirm using other indicators. You can, of course, dive deeper in details using the ADX the correct way. So we can typically look for values between 40 or 50 as suggested before, and this also suggests a strong and sustained trend. So additionally, you might want to pay attention to the direction of the positive DI and the negative DI lines, because these can be plotted in lines and we can check these out. So a strong uptrend is indicated when the positive DI is above the negative DI, while a strong downtrend is indicated when a negative DI line is above the positive DI line. This also works well to confirm on top of the value of the ADX. So traders can use ADX in combination with other technical indicators and tools, confirm trend strength, and make informed trading decisions. So it's important to note that ADX does not provide information about the direction of the trend. is it an uptrend or a downtrend? It just focuses on quantifying the strength of an ongoing trend that you might want to measure using a different indicator as well. So in this video, I'm going to show you how to compute the moving averages or the trend indicators. First, I'm importing pandas. We're going to use NumPy as well and Matplotlib to plot whatever we are computing. I'm using sample price data, so these are just points of prices. They are mock data at the moment. And to calculate the SMA or the EMA, first of all, we need a window, which is 5 here. You might want to take 10 or so, but looking at the size of my data, I'm just taking a small number. And in the SMA variable, I'm going to put the prices, which is a list. I'm going to cast it into a pandas series in order to be able to apply the pandas function rolling and provide it with a window. And for this window of 5 past variables or 5 past values, I'm going to compute the mean. All of this is done in pandas. As you can see, you don't need any fancy libraries or anything. It's just the mean of a sliding window over your data. And typically these would be the closing prices of your candles. Then for the exponential moving average, it's very similar, only I'm going to take an EWM function. I'm going to use this function, this method. So it's an exponential moving window. And we're going to provide the window and then adjust equal false. And then I'm going to compute the dot mean using the mean function to compute the average of this window. So these are two functions or two ways to compute the SMA and the EMA of the values. And we can plot these using Matplotlib. So the figure size, then we have the prices, which is the list I'm showing you here. I'm putting the labels, then the markers, and then we're going to plot the SMA, and we're going to call it SMA, and also the EMA, the exponential moving average. Going to label it EMA. We're plotting this with a title and so on, and this is what we have. We have the price, as we can see here. So in blue with the dots, and the SMA is this one, and the exponential moving average, which is the green one. So as you can see, the exponential moving average is closer to the price usually if you compare it with the SMA. That's because it has more emphasis on the most recent points, so it will change faster when the price is changing, and the SMA is more lagging in this case from this perspective. So this is for the first trend indicator example. If you want to apply this to real data, we can download the Bitcoin US dollars data and you can apply it to the closing prices. But for now, I'm importing the data from yFinance. So using the download function, this is the Bitcoin US dollar tickers. So Bitcoin US dollar exchange prices. The period, I'm taking the maximum period for the daily time frame. So it's going to be a few years back, starting 2014, as we can see here. And then I'm going to import pandas _ technical analysis, TA. This is a package that would allow you to compute any classic technical indicator without going into the hustle of coding it by hand. So you don't have to know the math that we have seen in the presentations. You just can call the function and it's going to compute the technical indicator for you. So here I'm trying to compute the ADX, and I'm using the TA, as you can see, technical analysis package. I'm applying it to our data frame, which is called data, that I've just queried and downloaded from the yFinance or using the yFinance package. So I'm providing the high values, which is title of the high values columns, low values, closing price, and so on. the length that I'm providing is 14. I'm appending this to the data frame. So whatever is computed from this function is appended into the data frame. And this function is going to return 3 different columns, the ADX, and then the DMP and the DMN. These were explained previously in the previous videos in the presentation. Now, if we take a look at our data frame, we can see that we have the open, high, low closing price, the adjusted closing price as well, and the volume. And then we have the 3 different columns that we have just added related to the ADX. And then we can plot this. So let's try and see how it looks like. So we're plotting the ADX, and this is our ADX. It's changing between 0 and 100. This is how it is. It's normalized, and we can see the shape of it. Now we can do the same. We can plot it along with the candles, and to plot the candles, I'm using again Plotly, and I'm providing the open, high, low closing prices as we have done in previous sections in this course. And I'm also adding the additional scatter using the scatter function. Yeah, x is equal to the data frame index, and the y is equal to the ADX14. His name is equal ADX, and I'm using a different axis for this, which is the y2. It's the right hand axis on the plot. We're going to see this in a second. So, and these are the attributes and the properties of the plot, the layout of the plot. So these are the candlesticks, and this is the ADX. Its axis should be on the right. We have one, but it's not seen here. Oh, it's appearing right here. So we didn't do it properly, but you can see that it's between 0 and 100, while the price is around 450 and so on. We can zoom in and see some more details, and we can see how the ADX is changing along with the price. So this is a very nice overlay, because it can show you probably how the ADX is changing along with the price. So if you want to study how the ADX is changing, this is a good way to do it. And some parts of this figure can confirm what we have been mentioning regarding the divergence of the ADX. So if you have a price going down just like this, and an ADX trying to go up like this, this might be an indicator that you might have a reversal in the trend. It might be just a possibility. It's all very stochastic, as you may have noticed so far. So there's nothing 100% sure. This is just a probability, and we're trying to put the odds on our side. Now let's talk about momentum indicators. So these indicators are essential for understanding the speed and power of price movements, and we will explore the RSI and stochastic oscillator. So the RSI is a popular momentum indicator used to identify overbought and oversold conditions, and we will calculate and interpret RSI with some examples illustrating its application. So the RSI is a momentum oscillator that measures also the speed and change of price movements. It's typically calculated using the following steps. So first of all, we have to determine the time period, choose a specific time period. Usually by default, it's the number 14. So we're using 14 candles in the past to compute the first value of the RSI, or the current value of the RSI. So this period represents the number of historical price points you will want to use and to include in the RSI value. And then we need to calculate the average gain and average loss. So for each period in the chosen time frame, calculate the average gain and average loss. Gains are positive price changes and losses are negative price changes. So it's kind of cumulative of how the price is gaining versus how the price is losing points, let's say, or decreasing. So the average gain is equal to the sum of gains over the period of n divided by n, the period, and the average loss is the same, so it's the sum of the losses averaged over all the periods. So Then we calculate the relative strength, so the RS. So this is obtained by dividing the average gain by the average loss. We just do the ratio of these two. And the RSI finally is nothing but the normalization of the RS. So we're using 100 minus this 100 divided by 1 plus the relative strength. So how do we interpret these values obtained with the RSI? The values are typically between 0 and 100, and these are used to identify overbought and oversold conditions in the market. And I don't think it's very reliable from this perspective. However, we can still use the RSI to our profit. So I don't believe that if the RSI is above 80, for example, you will have a downtrend because it's an overbought market. It doesn't work this way. And I don't believe, similarly, if the RSI is below 20, that you should buy. This is not, even if it's indicating an oversold area or an oversold zone, this is not how the RSI works. Anyway, if the RSI is above 70 on average, when the RSI crosses above the 70 level, it's often considered as an indication that the asset is overbought in general. This is the myth, I would say, but this is my personal opinion. So traders may interpret this as a signal to sell or take profits. I would say take profits, yes, but don't try to sell unless you are going with the trend. So if in a downtrend, the RSI crosses above 70, yes, you can try selling or taking a bearish position. And if in an uptrend you have an RSI below 30, you might want to buy. So this is more, let's say, more confirmed by another indicator. But I usually use the RSI to exit trades. So if I have a long position and then the RSI crosses above 70, I usually exit the trade because it might be indicating a slowing down of the current trend. So we might expect that traders might step out of the market and the price will stagnate or range for a while. So these are the two values. You might want to change these in between, let's say 20 or 80, 10 and 90, and so on. The third way to use the RSI is if it's in the range from 50 to 70, in this case, the market is considered a strong bullish market. So we have a strong bullish trend. And if the values are between 30 and 50, the lower end of the RSI, then in this range, we consider that the RSI is indicating a moderate bullish trend. And if the RSI is crossing from 50 to 30 within the range, then we consider it as a strong bearish trend. And if it's in the 70 to 50 range, then in this range we consider the trend to be moderately bearish. So what's the difference between 50 to 70 and 70 to 50 in this case, or 30 to 50 and 50 to 30? It depends on the direction and the slope of the RSI, how it's changing. If we can see, for example, the RSI crossing up from 30, from the level 30 up to 50 steadily, then we can consider this is going to be a bullish trend. We see that the RSI is crossing in the opposite direction from the 50 to the 30 level, although this is the same range between 30 and 50, but in the latter case, from crossing from the upper level to the lower level, this is indicating a strong bearish trend. So not only we have to check the values of the RSI, like in which zone is the RSI changing, but what's the direction of the RSI, what's the trend of the RSI, so we can try and guess what's coming within the price trend, or to forecast the future of the price trend. Another momentum indicator is the stochastic oscillator. So this indicator helps traders pinpoint potential trend reversals. So we'll explain its calculation, interpretation, and practical use, including identifying divergence. To compute the stochastic oscillator, we first have to choose two time periods, K and D, and the common choices are usually 14 for K and 3 for D, but you can adjust these values as needed. Then we can calculate the K value, so the current close minus the lowest low in the K periods, in the previous K candles, let's say, divided by the highest high in the K periods, or the K candles, minus the lowest low in this K period. So all of it times 100. Then we compute D as well. Typically, it's a 3-period simple moving average of K. So it's a smoothed value of K. It smoothes out the K line and is called the signal line. When these are computed, this line, the K line, is more sensitive to price changes and tends to be more volatile, and it oscillates between 0 and 100. The D line, on the other hand, is more of a smooth version of K, so it's slower somehow, and is often referred to as the signal line. So it provides a smoother view of the stochastic oscillator. Then the stochastic oscillator is primarily used to identify potential trend reversals and overbought and oversold conditions as well. So using the SO, or the stochastic oscillator, overbought and oversold conditions is the first case. So when K or D rise above 80, above the value of 80, just like what we have mentioned for the RSI, the asset is considered overbought. And this suggests that it may be a good time to sell or take profits. I would vote for the second option, take profits. Don't build your entry points based on the stochastic oscillator or the RSI, but it might be, these indicators might be a good exit point or exit indicators. Then when K or D falls below 20, the asset is considered oversold, and this suggests that it may be a good time to buy or consider a long position, or even exit bearish positions. About the divergence, this is where it becomes more interesting for this oscillator or for this indicator. Divergence occurs when the stochastic oscillator disagrees with the price movement. So there are two types of divergence. The bullish divergence that occurs when the price makes lower lows. So it's going down, the price is going down, but at the same time, the stochastic oscillator makes higher lows. So the lows of the stochastic oscillator are going up. Suggests a potential bullish reversal because the movement of the price going down is slowing down. It's not as fast or as important anymore. And this is reflected in the stochastic oscillator behavior. And then there is the bearish divergence. It occurs when the price is making higher highs, so it's climbing up in steps. But the stochastic oscillator doesn't agree with this. It's going to make lower highs. So this would suggest a potential bearish reversal. In the next video, I'm going to show you a practical example in Python, how to use the oscillators and the RSI, how to code these, how to include these into your trading system. So this is our Jupyter Notebook file, and it will allow us to compute the RSI and the stochastic oscillator. Let's go through it line by line or step by step. So we have the yFinance to acquire data, then the Pandas technical analysis package to compute the RSI and the stochastic oscillator. So we're going to download the data, Bitcoin, US dollar, for the maximum period, the daily time frame, and we're just adding one more column in our data frame, which is the RSI underscore 10, because we're using the length equal 10, so we're just making it clear for ourselves. Then I'm using the technical analysis package .rsi, the RSI function. I'm providing the closing prices and just the length. And this is it. This is how we can compute the RSI in our data frame. We don't have to go through the math that we have seen in the presentation and so on. So we don't have to have a big headache. This is the RSI, it's added into our data, and now we can just plot it. I'm using Plotly again. So I'm showing the open, high, low, close prices for the candles, and we're adding using the scatter function. The X is the df.index, so it's the index of the data frame, and the Y is the RSI. So that's what I'm adding, and I'm providing a different axis because I would like to overlay it with the price, show how it looks like. So these are some options, and this is what we have. So this is the red curve that we can see here, the RSI changing with the price. We can zoom in into a specific region, and we can see that the RSI is changing between 0 and 100. So here we have 80. It's never reaching 80 in this slice. Oh, it is right here. So we have 80, and when it reached 80, we didn't have a drop actually. This is why I was telling you I don't believe in this overbought or oversold myth. It's just a formula showing you that a price has been accumulating an uptrend for a while, and it might be reversing soon because it's been a while, has been on the same trend. So yeah, so this is how we can compute the RSI, and we can plot it, and we can also compute the stochastic oscillator the same way. So I'm applying it to a data frame.ta technical analysis. The function is called stoch for stochastic, and we're providing the high and the low prices and the closing prices columns. The fast K is equal to 14, the slow K is equal to 3, and the slow D is equal to 3, and we're going to append all of this to our existing data frame, and that's what we get. So these are the columns that we're going to get, K and the D, as we have mentioned these in the presentations. So when this is done, it's been added to our data frame. We can plot the stochastic oscillator, but this time I'm going to plot it on its own. I'm adding a trace on the side, so it's not overlaid over the candles chart. So, and this is the oscillator. We can see that we have two lines. One is moving faster with the price than the other one. And this is what we have explained in the presentation. So we have all the elements here to start our algorithmic trading if you want to include technical indicators into your coding part. Okay, don't forget that you can download these files if you want to practice or check the details. These are available as downloadable materials. So now we're going to talk about volatility indicators, and these are very useful indicators. Although, like all indicators, they are lagging, but they provide good ways for algorithmic trading. They facilitate and make things a bit easier for us in building algorithms. So volatility indicators, they help traders usually gauge the degree of price fluctuations in the market. And we're going to base a lot of our assumptions on these indicators. So how much is the price changing per time unit? How much is it jumping? And when the market has high volatility, this means that the price is changing quite fast in any direction, positive or negative, or even in both directions at the same time. So for this part of the course, we will introduce two of my favorite volatility indicators, the Bollinger Bands and the average true range. So we're going to go through both of these now in the next videos. The Bollinger Bands are nothing but a moving average, which is calculated over a specified period, such as, let's say, 20 days or for a 20-day Bollinger Band. And this is the orange curve that you can see here in the middle. It's nothing but a moving average, then a simple moving average. And then we have a standard deviation that's calculated for the same period of time. So we took 20 days in this example. And the upper band is this blue line, the upper blue line that you can see here. It's computed this way. So it's the moving average plus twice the standard deviation of the price. So we have this distance here is twice the standard deviation. The lower band is the moving average minus twice the standard deviation. And this 2 here, the factor, you can change it in Python. You can put 1.5 if you want to be, let's say, less restrictive, or if you want a very restrictive indicator, you can pump it up to 2.5 or 3 times the standard deviation. So 2 up to 2.2, something in between 1.9 to 2.2 typically is what we are using in algorithmic trading, unless if you have something different in mind. Bollinger Bands are usually used for identifying volatility and potential trend reversals. When prices are near the upper band, the asset may be overbought, indicating a possible reversal or a pullback, because we consider that the price will always tend to stay within these plus or minus twice the standard deviation and going back to the moving average curve. So if the price diverges up away from the moving average, we consider that it's going to come back and join it at some point. And this is how we can assess the situation, if it's an overbought or an oversold asset. So when prices are near the lower band, the asset may be considered as oversold, and this suggests a potential upward reversal. Then the center line moving average serves as a trend indicator at the same time. As I have mentioned before, this is one of my favorite indicators, and I did try it in an algorithm strategy, in an algorithmic trading strategy. This is a backtest with the results, and it revealed around 174% in returns and around 91% of win rate. There are ways of using these indicators. It's very easy to apply these indicators to, and they are very helpful and very useful to maximizing our profits. The second volatility indicator is the average true range, or the ATR. So it's computed using this formula, the previous ATR times n-1 plus the true range, what we call the true range, divided by n, which is the number of periods or bars or candles that you are considering. So this is the length of the period you want to consider in the past to compute your indicator. The ATR is the average true range, and the TR is the true range, which is obtained using this assumption. So the TR is the greatest of the following, so the largest or the greatest value of the following: either today's high minus today's low, the absolute value of today's high minus yesterday's close, or the absolute value of today's low minus yesterday's close. Notice if you go deep in these three different options, and we're checking the maximum of these three options, we're checking the maximum range of the price of the asset between yesterday's and today's candles. So this would provide us a good idea about the range of the price, where the price is moving, and what's the amplitude of the price wiggling from extreme low values to extreme high values. So usually a higher ATR value indicates a higher volatility on the market, while a lower ATR suggests lower volatility. Traders use ATR usually to get a sense of how much an asset typically is moving in a given time frame. And practically, we can use the ATR in a smart way to set the stop loss levels. If you have a low volatility market, you can squeeze your stop loss relatively closer to your position, which will be in your benefit. And if you are reading a high value of the ATR, you wouldn't want to put the stop loss very close, because you know the price is moving so much that it's going to touch your stop loss very soon. So traders usually use the ATR to set a stop loss levels using this way. A wider ATR may lead a wider stop loss to account for a larger price fluctuations. For example, if the ATR is if the ATR is $2, a trader might set a stop loss at $2 or $2.5 below the entry point to allow for a typical price movement. So this is just one simple example just to show how we might be able to use the ATR in trading. Now, to compute the volatility indicators such as the Bollinger Bands, we're going to use the same packages, yFinance to get the data, and pandas_ta technical analysis to get to compute the indicators, and then plotly to plot, and pandas, of course, for the data frames. So we're creating a new data frame called data. We're downloading the Bitcoin US dollars and so on, just like we have done in the previous examples for the previous technical indicators. And then we're concatenating in our data frame whatever we can get as information for the Bollinger Bands using the TA technical analysis package. So ta.Bollinger Bands, we're providing the closing prices and the length, which is equal to 14 here, called value, over the axis equal 1. This is going to create new columns and concatenate these columns to our data frame. So data.columns can be renamed because I needed to change the names to Bollinger Band lower, Bollinger Band middle, and Bollinger Band upper. The rest is not changed. We're taking a small slice of our data frame for the plot, and we're using, as usual, Plotly to plot these with the 3 traces of the Bollinger Band, the upper, middle, and the lower lines. And we're plotting these, and this is what we can see. I've colored these in a way that trying to make it a bit visible, but we can see the Bollinger Bands here. So we can see that the price, when the candles are crossing the upper band, price is going back down towards the middle, is the moving average, and when we are crossing the lower band, the price is also stretching back towards the middle. So this is really one of my favorite indicators for algorithmic trading. Then we can move on to the ATR, the average true range, our second volatility example, and same packages, same procedure. Only this time I'm defining a new column called ATR, and then I'm using the ATR function, providing the high, low, and closing prices, and the length, which is equal to 14 again, taking a slice of our data frame and making subplots to plot the ATR into a different subplot than the charts or the candles charts. And this is what we have. So this is our ATR, the average true range. You can see that the values are not normalized, so it can be any value depending on how the price is changing. So we can see that the volatility here is very high, for example, which is corresponding to this increase or sudden increase in the price. Volume indicators reveal the strength and conviction behind the price movements. So the normal volume indicator is a good start point, where if you see a high volume data, that's a good indicator that more traders are entering or exiting the market. So you have usually a high liquidity coupled with this. And therefore, this is a good indicator either supporting the current trend or the reversal, if you notice any reversal signals. So in this session, we will explore 2 vital volume indicators, the on-balance volume, the OBV, and the Chaikin money flow, the CMF. The OBV helps traders confirm trends by analyzing volume changes. So we'll calculate and interpret OBV and show how it can be used to identify accumulation and distribution. So how do we calculate the OBV? If today's closing price is greater than the previous day's closing price, OBV is equal to the OBV on the previous day plus today's trading volume. So it's somehow a cumulative of the trading volume, the normal trading volume. Today's closing price is equal to the previous day's closing price, and both OBVs are equal. So OBV is equal to the OBV on the previous day plus 0. We don't accumulate anything. Then if today's closing price is lower than previous day's closing price, then we remove the current today's trading volume from the cumulative of the OBV. And it looks like this. It's a cumulative value. It's stacking values or removing values depending on whether the price is closing lower or higher than the previous day's closing price. We can use the OBV to confirm trends. We can check the divergence signals. For example, if prices are rising but the OBV is falling, it might indicate a weakening in the buying interest, and it might suggest a possible trend reversal. So identifying accumulation and distribution, so persistent rising OBV suggests accumulation, so it's a buying pressure, which might also be associated with an upward price movement. In the opposite direction, if persistent falling OBV, it suggests distribution, so it's a selling pressure, or people are more into selling or shorting the asset. It's also a good indicator when we check the volume preceding the price movements. So the theory behind the OBV is that changes in volume precede price movements. So if you see a change in the OBV, then you can know somehow that the price is going to follow this change. So an increase in volume often precedes a change in price direction. It might be a selling direction or a buying direction. So just to recap on the OBV, in algorithmic trading, we can use it as a trend confirmation indicator, a reversal confirmation, or a breakout confirmation. We use it mainly for the confirmation of the signals. The Chaikin money flow, or the CMF, combines price and volume data to assess buying and selling pressure. So we'll explain its calculation, interpretation, and how it can help spot trends and reversals. So how to compute the CMF? First, we compute the MF multiplier, so the money flow multiplier, which is given by this formula, the close minus low minus high minus close, etc. So then the money flow volume is equal to the MFM that we just computed times the volume. So we're including the volume in the formula here. Then to compute the accumulation distribution line, or the pressure to buy or to sell line, in other words, we accumulate the money flow volume from day to day. So it's just cumulative. So the ADL, the current ADL, is equal to the previous ADL plus the current MFV, which is the money flow volume that we have just computed here. Then the Chaikin money volume is just the ADL divided by the volume, normalized by the volume. And this is how we compute this. Most importantly, you don't have to memorize all of these. You will not be using the formulas in your trading. It's just to understand a bit how things work. And most of these formulas are empirical, as you can see. So there's nothing based on any theory, just some simple assumptions that were included in these formulas. And in this perspective, nothing prevents you from just coming up with your own indicator that makes some sense behind it. So if you have an idea to support the indicator, or to explain why did you build and how did you build the formula behind your indicator, then it all makes sense. And as long as it works for you or for any trading strategy, it does make sense at some point. So CMF values above 0 indicate a buying pressure, suggesting a potential bullish trend, and CMF values below 0, they suggest the opposite, so it's a selling pressure and probably a bearish trend. So we use this CMF for trend confirmation. Rising CMF, also the trend of the CMF is important. So a rising CMF during an uptrend confirms the strength of the upward price movement. So this can easily be integrated in our algorithmic trading strategies. We can apply a regression line on the CMF and check if we have, using the moving average approach, check if we have an uptrend and confirm it with a rising slope of the CMF. This is very easily coded in Python, and it can be included in any of your trading strategies. Then the opposite direction also works. So if you have a falling CMF, during a downtrend, it confirms the strength of the downward price movement. So we can also use the divergence of the signals. So it's the divergence between the price movement and CMF movement. For example, if prices are rising but CMF is falling, it might indicate that there might be a future weakening in the buying interest and probably a future trend reversal. So this uptrend is slowing down, and this is confirmed by the CMF, which is falling, and we might expect a coming downtrend or a reversal of the trend. So this is it for the CMF and these indicators. I hope these were useful. We're going to put these in Python, and you can download the codes, the Jupyter notebooks, where I'm showing you how to include these into your strategies. You don't have to go through the formulas. You don't have to memorize any of these. It's not crucially important for the trading. It's just for our understanding at this point.
Есть одно место. sv.bet. Более 150 тысяч курсов по самым разным направлениям по цене пары пинт Эля в таверне. Вступайте в шервудскую банду прямо сейчас.